Hi, this is Randy Finney with Right Side of the Chart, and today it's Thursday, February 23rd, 2017. It is pre-market right now. It's about almost 10 till 9, a little after 10 till 9 Eastern Time as I'm starting this video. So these are charts that are reflective of Thursday's close. And I wanted to go over this video. I actually had planned to do a brief market update this morning. What I'll do, I'll just tell you what I see. There's not a whole lot there. I did take a look and notice one potential development on both the S&P 500 as well as the NASDAQ Composite, and that is that yesterday we had inside days on both of those. Inside days are trading day where you have the candle for that day is within the previous day's candle, meaning yesterday was Thursday, so Wednesday's highs and lows are higher than yesterday's highs and lows on both the S&P 500 as well as the NASDAQ Composite. Now, inside days they're not the most reliable candlestick patterns out there, but what you want to do is be on the lookout for any downside today, a red close, because what inside days do is they give you a heads up of a potential trend reversal when they come after a prolonged uptrend or downtrend. They can be used, to help identify bottoms or tops. So just something to point out there. And let's move on now and take a look at what actually is really standing out to me now as I go through the charts. About 2 days ago, I received a price alert on HSBC. I had this rising wedge pattern drawn, this fairly well-defined uptrend line. If you take a look, you can see there's a candle down here back in June at the lows, a couple other reactions. Either way, it forms a clean bearish rising wedge, very clear divergences. I'm going to talk about divergences quite a bit in this video. And here's the first divergent high. You can see this is a really, they're very clean. These lines come in together, but it's a series of two consecutive divergences. And as I often say, divergences most of the time, not always, I would say well over 90% when they're confirmed play out. And that one did play out for a healthy correction. I mean, if you want to measure it, grab the top. I'm just going next to that candlestick up top. That was a 9% drop. Now we had a second, even more powerful divergence. We had a series of extended overbought readings, and boom, breakdown. And this is what I think we're going to see more and more of lately. And I have seen this actually on a few stocks where you just get so extended. The patterns are clearly bearish. It looks like, back in, around election time when the U.S. elections that we were going to have a correction. We had that ramp after. But I just wanted to say these patterns are still very much intact. And just because we had a little blip that didn't go much deeper, 9% on HSBC, and I'm just using one stock, of course, we did push back up and make marginal new highs. That's happened in the broad markets, despite divergences that were in place at that time with a little correction, as well as many stocks. So there it is. This is a clearly bearish technical pattern. No mistaking it. Call it what you want. But that's a gap down, and that one kicked off with a bang. I believe it was earnings induced. Usually big gaps like that are, but either way, the technicals had priced that in. So now, why am I doing this video? I'm not short HSBC. That gap was a little too big for me to want to step in and short. Maybe if it were to back test, I don't see a back test at this point happening, but here's where I'm going with this. I took a look at the financials. For those of you not familiar with HSBC, it is and I'm quoting off Wikipedia, that's my source. I'm looking at it. It's the world's 6th largest bank by total assets. It's a multinational banking and financial service company. It's located in London, headquartered there. They're all around the world. Big company. So this is important. This is significant. A technical breakdown in one of the world's largest financial institutions. So what did I do? Doing the detective work that I do. If I see problems with one big bank, let's take a look at the rest. This is XLF. What I'm going to do in this video, guys, is just go through a handful. I'm not going to go through all the components of XLF. I'll go through the mega cap, the mega huge multinational financial companies, because I'm seeing virtually identical patterns, and I'll be clear, they're bearish patterns. Way back when, I had a believe I pointed out this head and shoulders pattern on XLF. This was a measured target. You can see left shoulder. This was just a flash crash. That candle is really not too significant. We snap back up there. So you have a pretty clean left shoulder, especially if you discard this huge candlestick, the tail right here, that shadow. Left shoulder, head, right shoulder, and there's a measured target. So number one, XLF has fully met the measured target for this head and shoulders pattern and then some. And if you're not familiar, to calculate the measured move of a head and shoulders pattern, you just take the distance from the bottom of the head to the neckline, which I did here, and you add it to the point at which the head and shoulders pattern breaks out. Or in this case, I should say inverse head and shoulders, which is a bottoming pattern. Regular head and shoulders, you flip this over, and that's a topping pattern. So there it is. Number one, we've already more than met the measured target. On the bullish side, we did have what appeared to be, and still looks like, a descending broadening wedge pattern. So, you can take this as glass half full, half empty, and that pattern would project more, and it could. Anything is possible. But what I'm seeing now, and here's a theme I'm going to go over, just like HSBC, we have negative divergence. We have very powerful, what I call potential negative divergence. Potential because especially the PPO, as well as the RSI, they're still turning up. So as you can see here, they're still moving higher, so they have the potential to burn through these divergences should they keep going up. Should, let's say, this descending broadening wedge pattern continues to have some traction, we move up. The divergences are then taken out once and if we exceed these previous reaction highs here on the PPO and the RSI. And I will say I don't believe that to be the case. Take it for what it's worth. A lot of analysis looking at these stocks, looking at these banks, but I'm going to make my case here. And this is something, again, a little early. We don't have any sell signals yet. The financials are clearly an uptrend, but I want to point this out because I see huge potential here for a swing short opportunity maybe coming up within the coming weeks to months here in the financials. So if you want to ask what I think will happen, I'll be very clear on that. I think at some point soon, and this aligns with my views on the broad market, will reverse. That will confirm these negative divergences, and they're very steep and powerful negative divergences. Now, a little bit goes into this. As I get into these stocks, I'm going to talk about some foiled negative divergences, and in those in some cases, as I like to say, and as we all know, the fundamentals can trump the technicals. This was the Trump pump. This was the presidential election right here in the U.S. Fewer sectors, if any, benefited as much as the financial stocks because Trump had campaigned on a promise to repeal or look into repealing some or all of Dodd-Frank. And if you guys aren't familiar with what that is, bottom line, it hinders, or at least the consensus was it was a hindrance for the banks. And so that was a huge surprise when Trump beat Hillary, which would have been status quo for Dodd-Frank. Anyways, enough of that. But that was a fundamental, an enormous fundamental catalyst that just launched the banks in almost a parabolic move. However, the question is, okay, let's say Dodd-Frank, let's just play, let's just hypothetically assume that it's fully repealed. What that did to XLF, I should say, that launched to this point, a 26% rally in the financial stocks just since early November. 26% rally. Okay, is that priced in? How much of Dodd-Frank, if any, and if not even too much of a repeal of some or all of Dodd-Frank is priced in? That's $1 million question. I really shouldn't sit here. We can sit here and debate fundamentals all day long. That's what they do on CNBC, Bloomberg, all those channels. They're always going to bring in a bear, a bull to make their case. You guys can figure that out yourself. I trade the charts. I think that's a much more accurate indicator. I'm certainly aware of the impact of fundamentals, but again, let's just go over a couple of charts and we'll wrap this video up. What I'm doing, I have the components of XLF here on a watch list, and I'm going to go through those in order of market cap. As you can see here, I have these sorted by market cap, and I'll just go through the top half dozen or so and try to make my case here. Right now, let's not be overly concerned about the trend lines to the left, although there are a couple things I'll point out which is a consistent theme. You guys hear me say often, especially if you follow the site for a while, I like to use the phrase that nothing is 100% when it comes to technical analysis, trading, investing, meaning there's not any one indicator, any one buy, sell signal, anything that even remotely comes close to being 100% accurate. There's just too many variables in the financial market. So I don't pretend that technical analysis is the be-all, end-all. But I do believe it's a much more accurate measure, especially of near-term prices. Now, if you're Warren Buffett, speaking of, here we are at Berkshire Hathaway, and you're just a whiz at reading balance sheets and doing fundamental analysis, which is what his primary trading investment style is. He's a long-term buy and hold investor. Great, more power to you. Fundamentals over the long run will prevail, and more often than not, the technicals reflect that too in those companies. I've rarely seen a stock that I've heard that Buffett's taken a nice stake in that I look at the chart and it had an extremely bearish chart pattern at the time. Remember, he's going to disclose when he's taken his share of his fill of a company. You're not going to hear about it before he does it. It'll move the market, so you're going to hear about it after the fact. So here's Berkshire. Enough ramblings there. There's Berkshire, and this is a common theme we're going to talk about. Here's a divergent high, just like we had in HSBC, just like we had in XLF, the financial ETF. Very steep. These aren't minor divergences. Very steep divergences. Again, we need to see confirmation. The confirmation being prices turning down. They just took out this previous reaction high. That was bullish. We had a breakout of this descending price channel. It was a very well-defined channel. See that bullish breakout? See, these technicals, they do work. You see a breakout. We didn't just limp out through that well-defined triangle pattern. We blasted on through it. Let me change that color on that circle so you can see it a little bit better. I'll make a white circle. So there's a huge, big green candlestick, pulled back, and then rallied up. So the action as of recently has been clearly bullish, and all I'm trying to do in this video is point this sector out, be on the lookout for any technical evidence of a reversal, whether it's a bearish candlestick reversal pattern, whether it's a bearish crossover, or just simply prices moving back down, falling back below that breakout level, which they should now hold on a back test. At the very least, they should hold this reaction below, and there's a bunch of levels below. Now, I wanted to jump on one thing, and the fact that, as I said, nothing is 100% in trading and technical analysis. This is a common theme you're going to see. This video will be over soon. We're only going to go over a few more stocks, but I'm not going to erase these trend lines. I leave these trend lines on to remind me back at this point where I put these crosshairs. If you look at the vertical line, you see very clear negative divergence. It wasn't as steep, but it was a little bit longer in scope here. You see negative divergence at the high, and that was right before, and it started to play out, believe it or not. That was, looks like September 7th, and we had an uptrend line, so this formed a wedge. This is the divergence line up top. I know it only connects 2 points. This isn't really so much to be a trend line, more so than to show you from this high here, from this peak, we went up. We made a high there, another high. So these two lines together represent this negative divergence. They show you that prices were making higher highs, while the PPO, you could put in MACD up, you'll see the same thing. RSI were making lower highs. That's negative divergence. It started to play out. So number one, you can't say that divergence didn't work. That may have played out if history was different and Hillary won the seat. Won the White House, then you might have seen more downside in Berkshire. Who knows? But what we do know for certain is that it's caught the market off guard, and people were positioned one way, and that's why you had this huge rally. You had short covering for those that were short in the financials. At least some point here, you certainly did. Nobody could sustain remaining short throughout a 26% rally in the financials. Wouldn't be ridiculous. And it changed the dynamics. It changed the fundamentals. And there's a little bull flag along the way. So, I just see so much in these charts, and I like to share it. This is the bull flag continuation pattern. So we ripped up, had a little consolidation, ripped out of that flag with an equally impulsive move. Nice, well-defined price channel. You could have been on alert for a breakout of that. Again, I wasn't trading Berkshire at the time. I just want to point these out, that these are the things I see on the chart. Back here we had bullish divergence. I must have had a MACD up at the time, so I didn't have it drawn out here on the PPO. So just as I point out negative divergences at times, I like to also point out divergent lows, and that led to really a break above. This was a longer-term downtrend. It goes off to the left of the chart. It's a 2-year chart, and look at the move it launched. So these divergences play out, again, guys, more often than not, and I'm just using a number. I don't have hard data, but I've been trading for many years now, and I would say that confirmed, clear, clean divergences easily play out for tradable corrections over 90% of the time, especially when confirmed with other technical evidence such as a trendline break, breaks of key support levels, reversal patterns such as a head and shoulders topping pattern, rising wedge, etc. Okay, enough on Berkshire. We'll go through the others real quick since I've made my point. And here's JPM. The common theme in this video is same story. You have a lot of these. You have some pretty decent. These aren't the best defined trend lines because you only have a few reactions, but they are a trend line nonetheless. You can see a clear bearish rising wedge. Just as I started out this video with HSBC, we had a bearish rising wedge, we had negative divergence, and that played out for a big pop. So if you're watching JPM, if you own it long, I can certainly see some support right here, horizontal support just below the wedge around 87.40. So your first sell signal would be a break of this uptrend line, then that 87.40 level. A little bit down here, there's a reaction low. That's about 83.28, and then there's just a ton of thin air below these bank stocks. And again, this is pretty powerful divergence. So I think there's a very likely in the coming months a nice shorting up coming up. Wells Fargo. What do I see when I look at Wells Fargo? I know there's a lot of lines on the chart. First of all, keep in mind that did I see that on? Yeah, okay. Going back to JPM again. JPM is one of the world's largest, if not the world's largest financial institution. I can't remember where they are now. This was a short. I pointed out looking for a correction. Shorted back on 714, divergent high. We broke down back tests, and look at that correction. That was a drop of. I can't click on all the marks because they'll move and I get that silly little pop-up, but that's a 29% drop at JP Morgan, and that was identified at the time. If you go back on the site, I was using the MACD, so I don't have the divergence drawn out here, and it goes to the left of the chart, so these divergences work. Here was another wedge breakdown. Now here's the case where the divergences didn't work, so I just want to in full disclosure say, well, no, we didn't have any divergence on the RSI, but now we have clear negative divergence, and JP Morgan's one to watch. I just wanted to mention that there it is. If you go back to July 14th, I must have a post on the site, 28% drop from when I posted. I was calling for a correction in JP Morgan as well as all the financials at the time, and I went over this one in detail. So when you catch these tops or bottoms, which I do, you're going to have a few cuts, obviously trying to catch tops and bottoms on stocks. But the point is that you can have some really oversized gains when you do. Okay, back to Wells Fargo. This must have been an official trade idea. That's why if I added hit, same story. I was adamant back then. The charts were clearly bearish. As I see now, I see a lot of bearish setups, and these weren't small gains. I can't recall where that was. You can reference that under the archives or completed trades, but I don't know where exactly we entered that. But if I went down to T3, must have been at least a 12% drop or so, somewhere around there. Again, depending where I shorted that. And here's a case where I was wrong. I took a pot shot after the Trump pump. This one ran up here. I had resistance. I think we shorted right here. Now this is trading, guys. This is trading 101. You keep your losses small. I can't tell you exactly. You can reference it. It should be under the completed trades. It would have been a relatively small loss. Stops are relatively tight, so you can afford you can get 2, 3, 4, 5 trades in a row if you're keeping your losses relatively small, using a 3-to-1 or better risk reward ratio. Risking $1 of loss to make $3 or more in profit. And but this is important. If you're stopped out on 2, 3, 4 trades in a row, and you see a setup that is presenting a gain of double digits, especially in the upper to mid to upper double digits, you have to have faith in the trade. You have to have faith in the charts. And I know this market has been extremely difficult recently because of, since the elections, it really distorted a lot of the technicals, and it's made trading more difficult than it usually is. So there's the charts working. I mentioned, it's not shown here, that sometimes they don't. With the Trump pump, that trumped the fundamentals trump the technicals. But look at this. Look at this uptrend line. A couple reactions here, numerous reactions here. That is a very steep uptrend line. From my experience, the steeper the uptrend line, the sharper the fall once it comes. So a couple things that I notice here. Wells Fargo is challenging. See these highs? That line is actually shown a little bit below. So it's right about, this is where we're failing right now so far. We haven't failed there yet. We're challenging. I should be more specific with my words. Challenging the 2015 highs. We have a bearish rising wedge, very steep divergences in place. That PPO is really slowing down, starting to turn down. And we could see a swift drop in Wells Fargo. And again, one way to play the financials, if you don't want to pick one company, you want to spread your eggs around a little bit, then you just go with an ETF. Less potential to make money than picking out the most bearish setups within the sector, but also less risk if you're either wrong or there's an earnings induced gap against your position. Here's Bank of America, same story, negative divergence. I don't have a very strong trend line to draw there, but I do have this pattern. These are just levels, and these charts are a little bit I haven't had time to mark these up with all the different price targets and support levels. I just actually started putting this video together this morning in pre-market. And of course, Citigroup, I'd be remiss not to point out Citi. There's a big one. You can see the divergences forming. And what I did here, you can see I don't have that trend line there yet because the PPO is still moving up. Looks like it's starting to curl over, but it hasn't yet. So we can move up here. We can move up here. In other words, it depends how high prices go. But no matter what we do, let's just say we're going for the next couple weeks higher in the financials. Let's do this. We'll move these lines up here, and we'll draw it out this way. So we have a little bit of upside. Wrong tool, guys. My point being that there's room for upside. We don't have any sell signals yet. So if we go up, that would, on face value, be bullish, but it would also set the stage for a potential bull trap. A bull trap is a failed breakout. You see this high back here in 2015, and that's a common theme too with a lot of these financials. Look at these highs. We challenged those 2015 highs for several weeks, failed, had a sharp rejection after it proved the bulls couldn't take that level out. The selling kicked in. It was very impulsive, so you could have profited off that pullback. But more importantly, we have a very well-defined trend line. I see a lot of reactions along the way now. So this is a well-defined wedge, and we could fail here again at the highs. It's certainly possible. Something to watch for. And if we do, watch for a break of this downtrend line. That could bring us all the way back here. There's support along the way. This is the first support level right here, I should point out. There's some pretty decent reaction lows. Chart's getting messy there, but you know what I'm talking about. Or we could push up, like I said. Doing so would still keep these divergences intact, as long as we don't go too high, that is. And then, boom, break down, come back in here. There's the previous highs. If we do break out, this should be and will certainly be a key support level right here because you have numerous reactions. Remember, in trading, resistance once broken becomes support. So that would be bearish sign number one. Let's say if we do break out to new highs, we come back in and we fail on a test to hold there. And what I really like about this chart, City stands out, is because if that fails and we go much lower, we'll also then take out the bearish rising wedge pattern. That would be a super sell signal. I love to see not one but two intersecting support levels break, or if I'm trading them alongside two intersecting resistance levels such as a downtrend line and then horizontal price resistance. And again, so here's your first target, get a little blip up there, and then could quite possibly come back here. But even if we're just looking for a pullback to that level, let's just say, and that would be a very shallow move, looking at the scope of this wedge, the size of this wedge and these divergences, that would be a minimum target there, right around this level. Call that, what is that, 55 or so. All right, I think that's enough. We already covered HSBC, so let's leave it there. Those are most of the big banks, and you get the gist of what I'm trying to get at here. The sector itself aligns. XLF, we already have a shot across the bow, if you will, on one of the largest financials with a clear, big breakdown. I mean, that was a nice gap down the other day. And I just went over just about all the mega banks in the U.S. that are U.S. based, and you can see that the charts are pretty much all saying the same thing. So here's a potential opportunity, and I can assure you, if and when the scenarios that I've pointed out here start to materialize, meaning I'm seeing some type of solid technical evidence of a reversal, failed breakouts, bullish candle or bearish candlestick reversal patterns, trendline breaks, etc., you'll start to see some official trade ideas. But for those of you that are interested, whether you're long or want to be short the financials, hopefully you found this video useful. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.